Hello, and welcome back to Crypto Clarified. I'm Dovile Silenskyte, and I'm responsible for digital asset research at Wisdom Tree Europe.
And I'm Vinh Tran, and I'm responsible for business development at Wisdom Tree Digital Assets.
What if I told you the person helping fix one of Ethereum's biggest problems used to crunch data for Mars missions at NASA? Incredible, right? Today we are talking to Amir Forouzani, co-founder and CEO of Puffer Labs. We talk about the solution that they have implemented after getting a big grant from Ethereum, and we talk about his vision for Ethereum for its future. Hello, Amir. Great to see you here. Welcome to Crypto Clarified podcast. Before we begin, let's start with you as an individual. You have an incredible career, and where you started and where you are at now are two different places. Would you mind talking us through, where you have been and how you got to Puffer?
Absolutely. Hi, Dovile and Vin. Thank you very much for having me on your podcast. I was actually looking forward to coming on podcast and talk to a lot of your audience. Um, Amir, I am the CEO and co-founder of Puffer Labs. We are focusing on yield and infrastructure of blockchain, and specifically, we started by focusing on the Ethereum network. Yes, like my career has has an interesting background. My primary interest has always been in research and researching hardware and hardware specifics for accelerating computations. That's where I have landed a research job at NASA Jet Propulsion Labs initially. Uh, Working at NASA, you have a lot of flexibility to work on anything that you might find improving human lives, from space communications to actually studying stars. You also get the flexibility of trying new platforms, including blockchains, quantum computing, or anything else that you might find interesting as part of your proposal. My entry point to this industry, along with others that might have had similar background for me, was computation, and specifically privacy-preserving computation. Um, there are many factors of computation and privacy-preserving computation that can be used in finance and specifically in blockchain and crypto. And through my introduction to Ethereum's researcher, Justin Drake, we have found out that my background and experience can actually be utilized to enhance the network of Ethereum. After having few discussions and receiving an Ethereum Foundation grant to build a solution, I have found out that it's going to be a very good opportunity for me to go down this path of improving the future of finance and blockchain through improving initially Ethereum's network. And that was the basic and the starting point of where we found Puffer.
Fascinating. And when you say you received a grant to build a solution, what problem were you trying to solve? Like what that solution was trying to achieve?
At that time, back in the year, I believe 2023, where like the initial discussions have started, there was maybe I'll just dive a little bit, like go a little bit more backward. What was the reason that folks were gravitated towards crypto or blockchain? The basic of it, it was all about owning your own money. Your money, your assets will be deployed on a network that is not controlled by an individual. The asset is not going to be inflated by an individual, or you're not going to get any surprises. You're not going to be surprised by, for example, things like 2008 crashes. That is why that was the moment that the blockchain started, which we initially know as the Bitcoin network. Later on, of course, Bitcoin we've got an upgrade to Ethereum network. Ethereum network is programmable finance. You can program today's financial primitives and products onto a network through computer programming, something that was not possible previously on Bitcoin. That's the point that was the birth of smart contracts. Fast forward, Ethereum upgraded from one primitive called proof of work to proof of stake. This meant to be able to actually validate the state of this network, to be able to showcase that this network is operating with zero trust, you had, as a validator, to put down some assets, your own money, to make sure that you're acting honestly, to report the balances, to report the state changes, and report the changes of entire network or those financial products honestly. In the transition to proof of stake, there was many challenges compared to proof of work. In proof of work, anyone with compute could have confirmed the state of the blockchain, therefore creating that trustlessness. However, it required a lot of compute and it was not environmentally friendly. And of course, as we have seen, there's going to be like many challenges with that as well with Bitcoin. The developers decided to move Ethereum from proof of work to proof of stake, or POS. POS required not only required way less compute, but it required some assets to be put to validate this network. Which Ethereum started by having 32 ETH as the minimum required to become one validator on its network. It brings a lot of advantages, but of course it created a lot of hurdles for decentralization itself. Liquid staking became a great primitive for folks with money, to come together with folks that have the knowledge of running computers to actually validate Ethereum together. However, it created another drawback. It created this sort of centralization. And at a point of time, centralized exchanges that had a lot of ETH were able to run a lot of validators. Massive liquid staking protocols also took a big share in running Ethereum validators. Why is this concerning? We're dealing with a network that, if a majority of its compute nodes are ran by a single entity or a single individual, and that actually crosses beyond 30% of the total compute of the network, they can have some sort of a power over the network. The first thing they can do, they can stop network from finalizing. What does that mean? It means we're not going to go from block 1 to block 2 anymore. They have seen that happening on many networks in the blockchain space. We wanted to solve for that. How could we solve for that? As a research problem, we looked at the space. We saw, okay, how do we diversify the number of people? How do we give more chance to folks to actually become nodes on this network, become representatives of this network that can be finalized, or AKA validators of Ethereum? We looked at what is a problem with solo validators. There has been a lot of risk associated with it, with running a solo validator on Ethereum network specifically. Proof of stake punishes dishonest operators through these things called slash, which means that if they're dishonest, if they're not doing their duties correctly, they will be slashed. We created a primitive that prevented from slashing actually like operations. That's where we got an Ethereum Foundation grant to start working on this product. And that became a foundation of us also becoming a liquid staking and liquid restaking protocol. That is for those little guys. That is for solo stakers. That aims on diversifying, running these validators to more individuals and a broader community rather than focusing it in lumps. And that sort of started to becoming like the first permissionless liquid restaking protocol that we are as Puffer today.
Excellent. And then there was an incredible phrase, own your own money. What does that mean to you, and what does that mean to Wisdom Tree in the US?
Yeah, that's a great question. And first, I think this is incredible, Amir, because we both, Dovile and I, are literally getting a lecture right now from an actual NASA scientist, and I don't think I would ever have in my life experienced this. So this is great. Yeah, I think ownership is incredibly important, and the idea of not your keys, not your token is definitely a common ethos that you hear a lot in this industry. And it's about custody, right? And in the end of the day, who owns your own assets? So, for example, when you have it at a bank, it's your money, It's your assets, but technically speaking, the bank is holding the keys to those assets, right? And you've seen a lot of issues in the past for bank runs, for situations where banks can lock up your money for other reasons, right? And what I think our industry is trying to solve for is the idea that what if we did not need that intermediary? What if we did not need a middle person to be in the middle of the process of owning assets, owning cash, moving money, and all of that when everything could be peer to peer? And I think that's a problem that Wisdom Tree, at least in the US, is really trying to solve with our products, and the idea of owning your own wallets, holding your own assets in self custody uh, systems where that you don't need permission from an intermediary to move capital around to own money. I think that is very important as we move forward into the digital age. Is this idea of self custody? So yeah, I think I couldn't agree more, and I think this is it's super fascinating. And I mean, I think you talked a lot about a lot of different things, and I want to double click on a lot of them. When you mentioned validator, right? I think you did a great job of kind of walking us step by step in terms of getting us to restaking and liquid restaking. To take a step back again for validating, what does that really mean when it comes to proof of stake?
Of course. This is a very good question, and I believe this is the foundational question that everyone should be asking before starting even using a blockchain network today. Because that trails all the way back to that custodying or owning your own money. The term, and this sort of follows with the term decentralization, censorship resistance, which I will certainly unpack what that means. But a validator, what is a purpose of validators? Why did we move to such networks? The idea right now behind blockchain is I can also run a blockchain at any time that I want. I can spin up a ledger and I can have you and Dovile start sending transactions to it and interacting with it. But since I am the only owner of this ledger or this database, at any moment in time, I can change your balances because it's my computer. I can just go in and I can say, hey, by the way, now, when instead of having $10 in your account, you have $5 in your account. That's something that you might see happening in a normal banking system as well. Or all of a sudden you have $10 and you will get some cash. They say, oh, sorry, we don't have your $10. You cannot get that back. Correct? That's where this is the basics. And a blockchain and the consensus was created to avoid this action. Instead of me only validating your balances, validating your transactions between each other, there is going to be a collective of people that are going to validate this and come to this thing called consensus on that state of network itself. Instead of me, for example, on Ethereum, today there is about a million validators that they all have to come to consensus that your balance and Dovile's balance are actually what they are. Not one validator can not change that. And let's say if you send $5 to Dovile today, not only me, I can be the block proposer as a validator as well. I construct all that information, but all the other 999,999 validators have to actually confirm that that transaction have happened. That is the basic concept of the validator and why we have validators in proof of stake. Previously in proof of work, validators of course there has to be an incentive here as a validator also to be honest, because still as a validator you can be dishonest. You can just submit a wrong vote. I can as one of these validators I can vote that no, these balances are wrong, and there should be a disincentive for being dishonest. Of course, for proof of work, beyond of course, consensus, there was that compute power and that effort that someone put into it. That was their sort of losing factor. But in proof of stake, it's the real assets of the validators that they put as their stake. They lock up their own assets. They say, I promise to be honest. If I am to be dishonest as a validator, I should lose those assets. That is what proof of stake is. There are many, of course, punishable actions that can be done as a validator. I wouldn't dive too deep into that, but these are called slashing. As a validator, you want to avoid slashing. And therefore, I would like to be honest and report correct balances without losing that money. And that's where proof of stake and validations really were introduced to many blockchains today.
Amazing. So let's take it over to Dovile then, because I know staking is something that she's been talking about a lot very recently, but from an institutional lens, right? So Dovile, how do you, or how do institutions, at least that you're talking to, view staking, and why is it an important part of an allocation?
So I talk to institutional clients all across Europe, and my key message is if you are investing in a blockchain that has proof of stake consensus mechanism, you need to make sure that you're investing in a product that achieves the highest staking reward in the most secure manner. And of course, then I encourage them to think about staking reward that is implied by the product they're choosing and ask them to adjust it for the management expense ratio that the product has and take a look at the net figure. And they always need to make sure that they're selecting the product that gives the highest staking reward. If they do not do that, then they're leaving money on the table. And I always try to tell traditional investors that when they invest into equities, they look at dividend yield. When they invest into bonds, they look at coupon. So when they invest into blockchains, the ones that have staking rewards, they also need to take a look at this. So it's very simple concept in my mind. But yes, I've been spending many hours talking about this via all channels possible. But going back to you, Amir, so you made references to restaking. Restaking sounds as if you're doing the same thing twice. And I'm sure it's not as simple as that. So, what is restaking and what is actually happening under the hood?
Of course. The concept might actually be like, this might be a familiar concept in traditional finance as well. So in staking, there are some assets that are used as sort of an insurance to make sure that a validator is being honest on the network. Now, the concept of free staking has been, what if we delivered another promise and actually went in to ensure other applications, other abilities through this validator we have. An Ethereum validator today does more than just validating the Ethereum network itself. Today, they provide data for L2s. They they can even provide a pre-confirmation to your transaction, giving you a guarantee that they will include your transaction into the next block, which all of these can actually be protected, and all of these can be underwritten by the same stake that is being used in their proof of stake, giving, of course, them a higher yield while undertaking a higher risk, because now they can actually be slashed for more. And that's the concept of staking. Um, because that 32 ETH, a lot of folks think that that is actually more than enough, and they can utilize it to underwrite more activities and more action as an infrastructure. As an example that I can give you, like what that really is today Ethereum has many L2s. And we created this concept that instead of having L2 by running by one sequencer, you can also have the Ethereum validators run that L2. I will dive into L2s and why do we even have L2s. You can think of L2s as a cheaper, faster environment to transact on compared to your own original network. Because sometimes your original network might be bulkier, it might have more validators to run, it might take longer time to sync, but you go to an L2 to do a transaction to be able to actually afford that cheaper and faster. These Ethereum validators can undertake another responsibility for proposing those transactions on the L2 as well, or giving a pre-guarantee to you to include your transactions in there, which is called pre-confirmations. That's where puffer precoms come in, which is our other product. But Ethereum validators have to take another risk to actually do this extra duty. However, they're going to get paid and extra for this. That's what is called restaking, because they are, in addition to doing staking, they're taking on another duty, which they have to also give certain guarantees for to deliver, which translates to higher yield. And that's what it is called restaking.
Thank you for this explanation. And Vin, I believe you have tokenized products on both Ethereum blockchain and also on a few layer 2s that are sit on Ethereum. Is that correct? And can you please talk to us about why and how and etc.?
Yeah, absolutely. So, at least in the US, our approach is to be as chain agnostic as possible, right? And we want to be building and meeting our clients where they are. So, a lot of the decisions for us to be on these various chains across EVM, the L2s, and non EVM chains is just a matter of demand. Clients coming to us and asking us, are you guys on this chain? We have demand for your assets on this chain. Can you mint on this chain? And for us, our ethos is to try to meet that in the most native way as possible, right? So for us, if you are owning a Wisdom Tree token, you are an actual shareholder in our products. And to do that, we're very careful about how can we mint these native issuances on these various chains, but do it in a very regulatory manner, right? So you're absolutely right, and I couldn't agree more with Namir in the sense of the need for these L2s when it comes to validation, when it comes to the speed and cost of transactions. So going back then, Amir, you talk a lot about access when it comes to restaking and trying to allow individuals, institutions with not 32 ETH, but 1 ETH to access the yields that comes from it. So how do you actually do that? How can you provide that access?
Of course. So, as an individual with 32 ETH, you lock your 32 ETH and you start doing certain commitments. You commit to become an Ethereum validator. You commit to propose transactions on an L2. You commit to do X, Y, and Z. However, this can be inefficient. Today, let's say, I'll give an example. Someone wants to have short-term bonds. 3 months short-term bonds, which actually, like, if you want to exit out of it, you have to wait for 1 month. But during that 3 months, your money is doing just one thing, which is accruing the yield of the bonds. It's not as efficient as it should be. That's where the concept of liquid staking was introduced to like blockchains. And what is liquid staking really? You can imagine, like, similar to bonds, you lock your assets to support a project, a government project, or an initiative to earn yield on it. Similarly to proof of stake networks, you can collectively come together. Me, Vin, and Dovile can come together, put our ETH in a pool, and say, hey, use our asset, proof of stake assets, ETH or any other asset, to run a bunch of validators for us. At the same time, we want a liquid receipt for the earnings and also that assets that we park in this pool that we can go and do other things with it. What if I want to exit out of my bond position without having to unbond it and wait 30 days? But what if I want to instantly just give it to someone else who's interested in that bond? That's where liquid staking was introduced. If, let's say, on Ethereum, you have 1 ETH, you don't need 32 ETH. You can have 0.1 ETH or even a fraction of an ETH and go to a pool and get a receipt token for your staked assets. In Puffer, which goes beyond just staking and offers restaking, which makes it a liquid restaking product, we offer those bonds, and you can come in with a fraction of ETH and you get this product called Puff ETH. Puff ETH is a yield-bearing asset. It just increases in value over time because your money is working for you. And at the same time, you get this efficiency of being able to go trade it. You're like, okay, I certainly need some ETH right now, or I need some USDC right now. I would like to remodel my I don't know, house. I need some money right now. but I cannot wait for that unbonding period to get my money, and then I go exchange it, and then I go get it. You have two options. You have many options here right now because now we have unlocked the whole realm of on-chain finance for you. You can use that liquidity staking token to borrow some stable coins and go ahead and do it, which is very, of course, tax-friendly in many jurisdictions. You can sell it to someone and actually go and use it without having to wait for anything. But at the same time, if you really want to earn that yield, you can just hold that liquid asset, provide it as liquidity pairs on a DEX. Do many other things that you can with this liquid asset to be able to gain yields on it. That's where liquid staking and liquid restaking was really born. And that's the concept that many protocols are actually offering right now on many different blockchains.
And I think you mentioned a very important part of why this can be important, and it's the ability to get to get debt on it or get leverage on your position that is typically staked and unusable. Um, Kind of transitioning that conversation more on the Dovile side, where you work with ETPs across the spectrum of crypto assets. Um, do you find that you're often selling a very similar product in that? It sounds like there are a lot of parallels between what Amir is doing at Puffer and what we're doing with the idea of an ETP, right? Making it easy to understand for investors, making it an easy access point. So, can you explain some of that parallel?
Yes, there's incredible parallel because both of us are trying to allow users and investors to do what they want in a more secure and efficient manner. So I talk to traditional investors who are now finding crypto as an exposure that they want to have within their multi-asset portfolios. For them, investing into crypto directly would be nearly impossible task. So they are able to invest into crypto via exchange traded product wrappers that they find familiar and comfortable to use and that plug in easily into their existing systems. And I think it's very similar to what Amir is doing from his side. But Amir, going back to you, so there are corporate treasuries who are sitting on tons of ETH, and I believe that they are increasingly looking at restaking to generate yield in a similar manner that they're looking to put cash, for example, into money market funds. Is my understanding and view correct, or am I, misselling or misunderstanding some of the nuances that may exist in the space?
Yeah, I mean, of course, like there are like a lot of interest, and really this interest comes with different appetites of risk. That's how I sort of like talked about like staking and restaking. It's all about different risk appetites with respect to different yields that they can receive. If they would like to just go to staking route or liquid staking route, just stake their assets, get a liquid staking token, and they're just exposed to one venue of revenue, which is just proof of stake on that network. What restaking really introduces, and I do believe restaking is still in its early days, by the way, because it has it has started earlier than it should really, um, is that with higher risk, they can get higher reward because their assets are going to underwrite more. And that's how they can like basically leverage their existing stake to do more. In addition to that, now they're dealing with a liquid restaking receipt or sort of liquid restaking token, um, which is not only liquid, but it has higher yield, which can be used in better leverage positions, which can be used better in lending, which can be better used in many other venues as well. Um, and this is the advantage. That's why a lot of capital allocators, when they want to diversify their assets across crypto products, they will put a bunch in liquid staking, a bunch allocated to liquid restaking, and of course, a bunch allocated to more leverage. That's where like many allocators right now are very interested in entering this space.
Interesting. And even when you talk to crypto native investors, I think your products allow them to get outside crypto space into traditional products via wrappers that they are able to access on chain. Is that correct?
Yeah, so the main difference I would say is there are two different types of yields, and we're trying to tackle the same problem is how can we enhance the user experience or the user optionality when it comes to these yields. So one, you could go to Puffer and get DeFi native yield through restaking and liquid restaking, or you can get the yield via, we say RWAs. I don't love the acronym, but real world assets. What does that really mean? For us, they're fund structures, right? So thinking about treasuries, thinking about private credit, different types of uh, different types of exposures that can generate a yield. So for Amir, I think the main difference, and I think I would be curious to know what both of you guys think is it's the times, right? The market dynamic now, and that I would like to think that crypto yields have been very muted over the past few months. How does that change your business model, if at all? And when you mention added yield from liquid restaking, where does that come from?
Yeah, of course. I think, of course, Puffer offers various products. We also do have vaults that does the DeFi yield, and I'm sure one of the reasons that Wisdom Tree, for example, brings their assets on chain to RWAs is this 24/7 market, which is very dynamic, and it can provide their users with access to a lot more options as if they would have just had their assets sitting in a brokerage account, for example, right? Like that's one of the advantages that someone will get. And certainly like you're exploring that as well. But on the risk-taking side, on crypto side, of course, crypto, one of its value adds was its volatility. Mhm. That's why initially a lot of like asset allocators got very interested and just jumped in because this was this exciting industry that was directly associated with money. Like I don't think any other industry, we can like talk AI all day, but blockchain specifically is directly connected to money and finances. And that's why it was very attractive for a lot of allocators to come in. Of course, it goes through its cycles, and it has more aggressive cycles than any other asset on this earth, I would say, because of the directions that it moves. And there are times that, for example, right now, it might draw less interest from the allocators because it's a more like calm time. Circling back to your question around where does that yield come from right now if they want to enter, that's where like at Puffer, we didn't wait for the technology to advance. We got our own hands dirty with this. We started launching this effort around Puffer Preconf and Puffer Unify. And what is it really that is going to come back and earn extra restaking rewards for our users? Puffer Unify is this new generation of what is called rollup or NL2 on Ethereum. And the idea for the main sort of uh, mission of it is to solve for the fragmentation of liquidity. If we, let's say, end up with many L2s on Ethereum, which is currently the issue, like we have fragmentation of liquidity. Let's say one Wisdom 3 asset wants to be exposed to the liquidity on Ethereum, and it sits on an L2 that doesn't have the liquidity pair that it needs. There are so many barriers to actually move across those chains and come and do it, which created this fragmentation, which created what I call the islandification of the network itself, right? The assets sitting on different islands, it's so hard to move across each other. The assets were issued there to get advantage of speed and cheapness of transactions, but they were not able to move. That's where we launched Unify. This next generation of rollups, which we call them based rollups, can actually communicate with the Ethereum L1, which majority of the liquidity, like above like $350 billion worth of assets, stable coins, and everything else were issued in. And this network, this L2, can enable anyone to go between Ethereum and this network seamless, which we call this, it's in sync with the Ethereum L1 or synchronous composability, which creates this like sort of connection, like seamless connection, while actually offering cheap transactions to the users. So there are many applications that require speed and cheapness. If you want to have like an options market or a perpetual market that actually holds your assets and you can trade with it, it must be on an L2. But the main problem of being on an L2 is liquidity. That's what we solve for. We give access to Ethereum L1 through Unify, which therefore brings more liquidity for all your financial products. who is in charge of actually sequencing this or running the transactions on this L2? It's the validators that are actually running on puffer restaking product. This is the extra duty that they undertake to process the transactions of the L2, therefore generating an extra amount of yield. So we're sort of solving these problems of the network multidimensionally while actually bringing higher yield to the table. And that's something that our restaking product or liquid restaking product, for example, can offer to users for higher yield. Um, in addition to that, there's like many other things that you can do that probably in a more specific, advanced conversation we can touch on. But there are other ways through block building and other things that you can also generate higher yield as well.
Amazing. And then moving to the next step, which is distribution. How do we get these types of products into the hands of users? You had a very big partnership with Anchorage recently, which is incredible. Congrats to you guys. A federally chartered crypto bank is now offering your product, a DeFi product. Um, One, I think for Amir, how did you get that to happen? And I think that translates well to Dovile in that your job is to get regulated institutions, allocators to often trust this technology and trust different DeFi protocols. Um, how do you guys do it?
Of course. Maybe I'll ask this question from Dovile first, and then I'll tell you, like, I'll let Dovile answer first because we, of course, had our own experience. I always want to know, of course, the other side. Dovile, like, let's say you guys want to like issue a new ETF or ATP, like Vin mentioned, like, what is it that you guys look for? And I know it's a very hard, long, process, but I want to know what is that list of things that you guys created before you even onboard one.
So let's start with investors. When I try to convince a traditional investor to allocate to crypto exchange traded product, it takes a lot of education. In most cases, I start from zero. That is, they have no or very little knowledge about anything. And then we usually talk about Bitcoin. And once investor has allocated to Bitcoin exchange traded product and has been invested for a couple of years, then they start looking beyond that. We as Wisdom Tree, we are very lucky because we have been operating in this space for over 6 years. So we launched the first product back in 2019. So now we have clients who have been holding our products for 5-6 years, and they're looking beyond beyond the traditional Bitcoin, and they say, okay, what else is there? And then that's when we start talking about Ethereum, Solana, XRP, Stellar Lumens, and a number of other names. But if we were looking to launch a new exposure, we still need to work with various limitations that exist in the current place. For example, we can only launch a product that can be listed on key exchanges. And exchanges, they have their own rules for which cryptocurrencies can be held by the product. And also, we work with regulated custodians. So whatever exposure we choose to have within ETP, our exchange traded product wrapper, it needs to work for the custodians as well, because we will need them to be able to custody digital assets in secure, segregated cold wallets. So there are multiple checks that we run from operational perspective before we say, yes, go ahead. But if the decision to go ahead is made, then a lot of work turns my way, because I need to draft everything from explanations for what this exposure is, to what its real world use case, to why it makes sense to allocate to it, and etc. etc. So it's not an easy task. So fully appreciate, Amir, the work that you are doing as well.
And of course, yeah, I mean, exactly for us as well. Like you mentioned, then how did we get onboarded here, right? Like, as like issuers or custodians, like yourself, like Anchorage and other folks, um, the first thing they want to show their investors is transparency of a product. This is exactly what the product does. This is the risk associated with the products, and this is how much yield you should expect from this product that we're offering. And that was the initial point that we started working with Anchorage before we get onboarded. Of course, Anchorage is a very professional and great team, so they know all about this. So we provided them first. This is a fully permissionless restaking product. This gives it a great decentralization factor. Anyone who runs a validator on Puffer network is insured by a 2ETH bond, meaning that they, unlike other liquid staking platforms that operations are not insured. Let's say if a massive slashing happens beyond $1 million, nobody can underwrite it. At Puffer, if up to 2% of the total ETH staked on Ethereum gets slashed, then we start to just get to socializing the effects of the risk. Which means, right now it can translate probably to about like $1.6 billion worth of like slashing penalties, which is a huge insurance, like active insurance provided by the node operators themselves. Something that didn't exist anywhere else. That's what stood out for Anchorage, for example. They're like, okay, a financial product needs insurance. It's much different to provide like this insurance on a crypto project versus on just a normal financial project. As you know, for example, in America, banks are underwritten by the FDIC. If your money in the bank gets stolen or something else, they insure it for up to $250,000. You have seen, for example, in the case of Silicon Valley Bank, a government underwrote the entire thing. They said, okay, we're going to give all the money back to you guys. That's something that is rare on the blockchain and crypto itself. There are, of course, insurance providers, but for the sizes that we're dealing with, it is hard to provide that. That's where at Puffer, because we are the coordination layer between the asset holder and the validator, we make sure that the validator brings their own skin into the game, which is 2 ETH per 32 ETH. They're undertaking a 16 of this. So this creates a lot of buffer and comfort for investors to actually allocate to Puffer itself. In addition to that, we created a lot of transparency, a lot of code audits saying that this is how Puffer operates. These are the actual risk associated with its operation. There is a term that is going to be heard over and over again by investors these days, especially, which is a smart contract risk. They have to actually be also quite transparent about our smart contract risk and the other risk factors that makes investors to go in. And after, of course, a long process, we were onboarded with Anchorage through this. We were able to establish a great understanding of our product, which made this an easy choice for Anchorage eventually to onboard. And we're very grateful to our partnership with them. And I believe like many other institutions should also start like asking the same questions.
Very interesting. And now to conclude, 5 years from now, what does Ethereum look like if Puffer's vision works?
This is a very, very good question. You know, if we came into this space as Puffer to create a very good decentralization runway for Ethereum. That was the motive for our permissionless liquid restaking platform, because we wanted to make sure that we have as diversified as possible of validators, that the network is going to be as decentralized and censorship resistant as possible. Censorship resistance is arguably the only value that a blockchain can offer to its users, because the transactions cannot be censored, the balances cannot be modified, and that's one of the biggest value adds that it brings. And that's what we wanted to do. Now, I believe Ethereum, of course, faces yet another challenge, which is being able to host more financial products at scale. That has been an issue for Ethereum. That's why there has been arguably some leakage to other networks, because it couldn't deliver that in time. Of course, there are many great researchers at Ethereum, Justin Drake and others. They're working on Ethereum's straw map. Ethereum is going to be, in 5 years, the most technologically advanced blockchain. Something that I believe other blockchains, like always, will probably come second, third, or fourth after that. What they're doing actually is they're making sure that Ethereum's quantum resistance. Quantum is something that everyone must start thinking about, like especially investors and financial allocators. In addition to that, it's going to be faster, but it's going to take some years. And during these years, we cannot have value leakage from this network. And of course, it's not going to be trust leakage. The investors are also having an opportunity cost. The investors that wanted to build on the trust of Ethereum are going to somewhere less trustful, a little bit more centralized, and they have to do this trade-off. We want to solve for that. We want to solve for that much sooner than the next 5 years. That's where we launched Unify. We believe Unify is going to help scale Ethereum with its own like extensions or rollups or L2s or based L2s, which is all the same thing. What we can do on Unify very soon, we can, of course, start offering perpetuals at scale to all Ethereum users. We can offer all the new market primitives like prediction markets that also require scaling and speed. Ethereum is a great platform today for lending, for some spot swaps at a good execution price. But there are many more financial primitives that need scaling, need speed before actually being deployed on Ethereum. That's where Unify comes in. We are going to create a platform that these future primitives can actually launch on, and through us, they will launch on Ethereum. They will expand Ethereum, they'll get Ethereum up to speed, and of course, trading becomes far more seamless. One more item that is for less sophisticated users and is for the future of AI itself. That's why we see Cloudflare wants to do their own stablecoin. Many other Web2 tech companies or other even AI-related companies want to do their stablecoins, is payments. Normal payments. You want to make payments easier. Something that Ethereum can probably not handle at scale today. Because as soon as a large volume of payments hits Ethereum today, the gas fees are going to spike again. This is not going to be good for everyone. That's what another thing that Unify will focus on, peer-to-peer payments, in addition to creating payment platforms for new stablecoins, new issuers, to give them better distribution by actually being able to connect to the liquidity of Ethereum itself. Um, and that's going to be really the future because I believe blockchains are far more efficient in processing and handling payments without cutting a lot of like hidden fees when the money actually moves. So that is something that we see many other big companies like Stripe and others are trying to solve for as well. And we need to get there as well. And that's our contribution, continuous contribution back to Ethereum, which of course involves us closely working with the foundation, with the Ethereum institutional, and of course the newly launched ETH Labs. These are the two institutions that are going to undertake more onboarding for protocols like us to institutions and like us to doing more research, while the EF continues the straw map roadmap of itself.
Brilliant, brilliant vision, and thank you so much for your time today. It was incredibly interesting discussion, and we hope to see you in the future in one of geographical locations that we always travel to.
Of course, thank you very much.
To clarify, the views and opinions expressed in this podcast are those of WisdomTree and Puffer Labs and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results.